Well, we have gotten our first evidence that the private sector is being impacted by the policies being put forth by the President Trump. Again, we have known for quite a while that government spending is going to be going down. We've had indications for at least the last 6 weeks that the consumers are scared, nervous, whatever you want to call it. But now we've got a corporate CFO survey that frankly should be alarming to folks in the administration. You can find this on CNBC. According to the corporate CFO survey, 95% of CFOs said policy is impacting their ability to make decisions. Why is this important? I don't know if you've had the opportunity to work with, to pitch, to whatever you want to call it, work with CFOs at companies, which I have. And CFOs, generally speaking, are risk averse. I think that's fair to say. They are watching, the bottom line. They're watching their cash reserves. They are, generally speaking, not afraid to make investments, but they want to make sure those investments, that spending, has a positive return for the corporation. If it's a public company, a positive return for stockholders. And if you have 95% of CFOs saying the policy is impacting their decisions, what does that really mean? Well, it's pretty simple. They mean they need to, they're going to sit on their hands. They are going to sit on their hands. So that is not good. That is simply not good. And again, I think what we're seeing in 2026 is an environment where government spending is being ratcheted back quickly. The hope is the private sector and the consumer step into the breach, and we continue going forward in a positive direction. That timing that we hope for, wish for, want, just doesn't feel like it's going to line up. So same survey, CFOs, 60% of CFOs think we are going to have a recession in 2025, with 15% saying 2026, which is interesting. So that's a total of 75% of CFOs. Generally speaking, this survey was very pessimistic. For context, last quarter, so 90 days ago, it appears that only 7% of CFOs said there was a recession coming. So very much a vibe shift. I do want to go to the comments. Guys, I do have the comments up on my screen. I see that Old Guy REI or Frank says, Zuber needs moderators to keep you riffraff out. I have no idea what that's in reference to, but maybe Dion does. Maybe Dion kicks some folks out. Not sure, but thanks. Dion is a moderator for the channel. Happy to have others, people I trust. So again, corporate CFO survey, 95% basically said we're going to sit on our wallets. We're not going to do anything. We're going to wait for the environment to clear, which is, frankly, good news. If you were with me in January, I told you the first 6 months were going to be chaotic. I warned you. This should not be news to you. The other thing that you should realize, which is great news, which I think a lot of people miss in the fog of war, we're halfway through. The end of March is like the weekend or something, right? Maybe it's Monday or Tuesday of next week. So we are almost through the 6 months. And then we get to see where this U.S. economy goes. Then we see, no tax on tips. We see, these other things, and probably lower rates if we do have a recession in the first half. So again, we are halfway through the chaos, and kind of like a hurricane. I've never been through a hurricane, but I imagine once it's left, there's obviously some destruction, but you also have hopefully blue sky so you can rebuild and go forward from there. We did get some other economic data, lots actually. We got Richmond Fed manufacturing going negative, kind of like the New York Fed, or Empire State, I think they call it Empire State, was 6 positive, which means growing. Now -4, meaning contracting. So again, -4. The estimate was for a +1. So there we go. Consumer expectations of inflation continue to spike. Again, folks, we just talked about CFOs. Now we have, again, further examples of the consumers. I think this is 3 months, might be even 4 months in a row, where consumers' expectation of inflation continue to rise. This is, again, being spun up, obviously, by the media, by the chaotic communication style, and frankly makes a ton of sense, right? If you are not an economic person, or you don't read below the headlines, I think it is extremely realistic for you to say, oh my God, prices are going to get worse. Makes total sense. U.S. new home sales, a little bit better than last month, 676,000. Last month was 664, so up almost 2%, but it was below expectations. Expectations were for 680. Earlier last week, we talked about Lennar. Well, KB Homes came out with earnings, and they were nasty. They were garbage. KB Homes missed top line, missed bottom line, missed margin, lowered guidance. It's like all kinds of bad. I did look at their earnings call presser, right? The summary. I took a couple of quotes. Labor not impacted by ICE raids. I thought that was interesting. Again, I've seen stats as high as 50% of workers in construction are illegals. I don't know if that's true, but I've seen that stat. It's interesting also that the CEO of KB Homes is being asked that question about labor. So again, no impact from ICE raids yet. Best market, KB Homes, Las Vegas, Nevada. In fact, they are raising prices in 2 of the largest communities. Also, KB Homes bought 2 big plots of land. So clearly making investments in Vegas. Worst part of the country was Jacksonville. Jacksonville has 7 months of inventory. So you could expect folks to get some significant price reductions. KB Homes said 50%. Every other community had price cuts in the last quarter. 50% of KB Homes are first-time home buyers. The thing I tried to figure out, and maybe I'll ask Lance at Resi Club, is what's been the average for KB Home? KB Home, in my opinion, delivers first-time home buyer product. That's what they focus on. They highlighted that 50% of their buyers were first-time home buyers. And then lastly, consumers are concerned about the macroeconomic slowdown, and thus it's slowing down their buying decisions. Not to be outdone, another quote from Lennar. Lennar CEO says, home prices are falling. This is obviously new homes, but job security has become a new concern. Again, folks, if you watch this channel, this is not news to you. Consumers can turn off demand in an instant. Demand falls quick, supply doesn't. This is what we are seeing across the country. I do want to call out the most impactful presentation from the ORAT event in Vegas. I got to tell you, a lot of you were sleeping on this video. If you know YouTube speak, this video got a 10 out of 10, which is not good. What that means is it's the 10th worst performing video by clicks. But I got to tell you, it's the most impactful presentation from the ORAT event. I'm so glad we got it out. The title is How to Improve Your Life via Understanding Your Mess, MES. This was done by Fred, a pastor, mental health professional. I was so glad to bring it to everybody in the YouTube world because I think it will help you in your life. And I definitely recommend giving that one a shot. And frankly, sharing it with folks that you know are in maybe in a bad spot. There's a lot of negativity out there in the world now. I think Fred's presentation was the most impactful presentation. In fact, I know it was impactful because at the end, our friend Jason Pritchard actually got up and asked Fred a question. as did his wife, which I thought was very, very cool. So, again, check that out. We did get some Fed speak. We got Fed President Williams and Kugler. We'll do Williams first. Households and businesses are seeing heightened uncertainty, AKA sitting on their wallets. This is where we are, folks. This is where we are. Fed President Kugler, latest economic data has shown signs of softness. Labor market appears stable through February. I thought it was interesting he threw the through February on there. Just me. Paying close attention to acceleration in price increases. Lastly, return to positive goods inflation is not helpful. You guys remember, I think it was 18 months ago, we were talking about goods inflation and services inflation. For quite a while now, goods inflation has been subdued. It was basically services inflation that was carrying the day. According to Fed President Kugler, that is no longer the case. What else do we got? We got Case Shiller. Case Shiller came out this morning. This is again for January, very much backward looking. I do not anticipate these numbers being true for February or March, but they are what they are. Case Shiller home prices up 4.67% year on year. Again, sorry, Crash Bros. No dice yet again. Consumer confidence actually continues to fall. It was 98.3 last month, came all the way down to 92.9. That's a pretty significant drop, and frankly, one that should be expected given what is going on in the news cycle. Let's go to our boy Mike Simonson from Housing Wire, Altos Research. Every week he does a summary of what's going on in the MLS or active. So here we go. Pending home sales up 2.3% year on year, 69,000. Active inventory up to 668,000. That is up 30%. Yes, folks, inventory is up 30% year on year. New listings for the week, 70,000. That is up 9% year on year. Price reductions up to 34.3%, and price up 1% year on year to $394. What does all that mean? Folks, it's very, very clear, and it's been clear since January 1st. More inventory, more opportunity to find motivated sellers, and frankly, less competition. We are seeing the spring selling season start very slowly, but as investors, as I said on the Ryan Pineda podcast, the investors are going to be the only community that wins in 2025. That and new home builders that build small homes. But yeah, it is going exactly like I expected. More inventory, more options, better opportunity to find motivated sellers. Still plenty of wish pricing out there, but hey, it's your job to go find it. Probably the most interesting stat I read this week, shout out Lance from Resi Club, was the Mortgage Bankers Association interest rate forecast for 2025 and 2026. Get this. Buckle up for this. By the end of 2025, Mortgage Bankers Association, which you and I should assume have rosy glasses for rates, only sees interest rates going to 6.5%. I forget what they are today, maybe 6.8. So they see a little bit of reduction to 6.5%. But here's the big number. What does the Mortgage Bankers Association think rates will be in 2026? I guarantee you, unless you read the report, you will have no clue what you think that the Mortgage Bankers Association is calling for 2026. You know what I'm going to do here? I'm going to pause for 10 seconds and let all of you guess what crazy interest rate Mortgage Bankers Association thinks the 30-year mortgage will be in 2026. So go ahead. You guys are watching me live, 104 of you now, 102 of you. Let me know what you think the mortgage bankers guessed that 30-year mortgages will be in 2026. All right, we've got our first guess at 4%. Anybody else out there want to take a second to put in a guess? 9%. All right, we got both extremes. You guys are awesome. 4.5. All right. So again, folks, 5.5. Oh, thank you guys for playing along. So let's get into it. 2025, December 31st, 6.5%. Here we go. 2026, 6.4. 6.4. They expect mortgage rates to be flat for 2026. 6.4, 6.4, 6.4, 6.4. So what does all that mean? Well, higher for longer. All right, we've talked about that. It also means likely that we don't have a recession. We don't have a recession. One of the things that I think you'll see in a video with Taylor this morning or sometime today is we had a good chat about what happens if we have a recession and what happens if unemployment spikes and we have a recession. And Taylor was pretty adamant that we're going back to the zero bound. I don't know about that. I don't know. As I said in that video, I hope we don't continue this yo-yo of, raise rates, go to zero, raise rates, go to zero. I really hope we don't do that. But again, if you're calling for a 6.5 in 25 and a 6.4 in 2026, you're really saying no recession. That's what that call means. No recession. I do want to make a couple of school announcements. One of our masterminds, the Unicorn Agent Mastermind, which meets this morning at 8 o'clock, so in about 14 minutes, it will be changing to, what would that be? 1 p.m. Pacific, 4 o'clock Eastern. Hopefully that makes it easier for folks to join. I do want to shout out all 6 of our accountability groups that meet each and every week. You guys are amazing. You guys are really driving the community. So thank you, thank you, thank you. After this morning, the Unicorn Mastermind agent event will move from 8 a.m. Pacific to 1 p.m. Pacific. So again, there you go. And we have one new school member. Hopefully I get close to pronouncing this correctly. Con. Thank you very much for joining. Again, joining school is the right thing for all of you to do. 67 pennies a day, 350 plus folks go in the same direction, 6 different accountability groups, thousands of dollars in free education, and a place that you can ask questions and network and all of that. Let me just scan my notes real quick, make sure. Oh, one more thing to talk about. Deutsche Bank. I actually read this. I should have talked about this earlier. Deutsche Bank putting out a article talking about the chances of a recession occurring in 2025 are now 43%. More importantly, in this article, it says the Fed may have to choose between boosting growth and tamping down prices, aka stagflation. Stagflation is a real risk that we haven't seen since the 1980s. This again was in a report by Deutsche Bank. So folks, I hope you have an amazing day. Like, subscribe, comment, become part of the family, become part of the folks going the same direction. I will see all of you in school. Take care. Later.